Good afternoon, everyone. I welcome you all to today's webinar. Today is also a special day. It's Autistic Pride Day, a day to celebrate the unique strength, talent, and diversity of individuals of the autism spectrums. We have with us Ms. Kiran Telang, who will be leading today's webinar. Ms. Kiran Telang is SEBI Registered Investor Advisor and Certified Financial Planner. She has more than 20 years of experience in the banking and personal finance industry. She is the author of two books, Mindful Retirement and Money Wise Perspectives for Women. She is actively involved in many financial literacy programs, is a part of the NISM Retirement Advisor Exam Committee, and also teaches at IIM Indore. She regularly shares her views on personal finance through media platform. She holds a Master in Management Studies from the University of Mumbai, is an AMFI certified mutual fund advisor, and is also junior associate of the Indian Institute of Bankers JAIIB. This webinar is being organized under the Financial Education Initiative of the National Institute of Securities Market NISM, which is supporting today's session. The National Institute of Securities Market NISM is a public trust established in 2006 by the Securities and Exchange Board of India SEBI, the regulator of the securities market in India. The institute carries out the wide range of capacity building activities at various levels aimed at enhancing the quality standard and security markets. Before we begin the session, I would like to share the few important points with all participants. Question will be taken at the end during the question and answer segment. All participants will receive their certificates of participation in 3 to working days. The recording of this session will be uploaded on the official NISM YouTube channel. Now, without taking much time, I would like to hand over the session to speaker, Ms. Kiran Telang ma'am. Thank you.
Thank you, Namrata, for the introduction. Welcome everyone to today's session. So today we are going to talk about financial planning for special needs families. This is a brief introduction which Namrata already gave you. So I will skip through these. Introduction about NISM. Q&A will keep to the last 15 minutes of the session today. So let me just finish my presentation and then we can have a Q&A session. I have divided this presentation into a few subcategories so that there is more clarity in what we are talking about today. When we talk about financial planning for special needs families, how is it really different from regular financial planning for regular families? So how do you begin? Where do you start? Because it's a very tough thing, first of all, to accept that there is a special needs child in the family. So the acceptance, the emotional issues, all those are there. So how do we start? Where do we begin to put the money bit in place? Because money is extremely important. If money is in place, there are a lot of other things which you can focus on. You can provide for the special child. You can provide for your family's other requirements. So how do we go about it? First thing that we need to do is actually envisioning the kind of life that we want to lead. So envisioning your life would include actually writing down what is your family structure, how do you want to create your life with your family. So what happens more often than not is when there is a child in the family who's a first child and the child is a special child, there are often issues and thoughts, whether there should be a second child. It starts from there. So how do you foresee yourself living your life going ahead? What is the lifestyle that you're going to lead? What is your social life going to be? Because it's not easy to have a regular social life with a special child. So how do you see yourself? There are other issues which you need to focus on also. When the child is an adult, if the parents are not around, where is the child going to live? That is an important question to ask. How can you make your child more independent? Because even if there is some dependency because of some disability, it could be physical, it could be mental. How do you ensure that your child is more independent? So what are the steps that you want to take for that? There will be people in your family and in your social circle, in your community. How do you make those people aware of your child's requirement? How do you involve them in the care of your child? It could be as small as, including the child in play within your society or wherever you're living. So those are things which you need to give it a thought. And once you have that in place, then we can look at how that vision of yours will be achieved. There are no right and wrong answers. There is nothing black and white in this. But at least if you enumerate what you want to do, what is the kind of life that you want to lead, it will be easier for you to focus and go and achieve those things. Now, there is something known as letter of intent, what you can create. A letter of intent essentially, is a written document which states how you want to live your life. Uh, it gives the core requirements for the special child in the family, so that in case there is a time when somebody else wants to take over, has to take over the responsibility, at least your intention is clear. So you've written down where the child is going to live, you've written down what care is required, you have written down how you want your child to study, which school, and all those things are written down in the letter of intent. So that is kind of putting down in writing what you want your child to go through, going forward. And if somebody has to take it over, the responsibility of the child, how will that person know that what was your intention? So the letter of intent will give you all those things. Next, you need to look at what is your support structure. It is said that it takes a village to raise a child, and if there is a special child, you will need even more support. So, who is your support? So, within family, are there siblings who can come to play? Are there other relatives who can come in when support is required? Are there any close friends of the family who can support in times of need? If there is a shortage of family and friends in for support, there are also charitable organizations, normally NGOs, who can help in such structures. So mostly these NGOs have been created by parents of special needs children, so they will be very much aware of what is required and what are the issues in bringing up a special needs child. So those can also be a support structure in different ways, not only in terms of giving you knowledge about how to bring up the child, in terms of giving options for interaction, social interaction, some means of making the child independent. So there are various things. So you need to figure out who your support structures are. Here I would like to point out that it is also necessary for a parent to think about guardianship. So as long as the child is a minor, the parents are the natural guardians. But once the child becomes 18 years old, when the child becomes an adult, the parents are no longer considered natural guardians. So they will have to take a letter of guardianship from the court for the adult child. So that is an important requirement. Also, in the minority of the child, so when the child is below 18, if something happens to the parents, the natural guardians, who is it that you see coming, stepping into those shoes? Who will be the guardian in case the child is still a minor and the parents are not around? So that is something that the parents will also need to think about and put structures into place to ensure that the guardianship is not left blank. The third step, where I would take a little more detail, is creating of safety nets. So creating of safety nets is essentially building, insurance in place so that if something goes wrong in the life of the parents, the child is not left uncovered. So the most important thing in creating safety nets is having sufficient health insurance. So even in families which do not have a special child, health insurance is a critical aspect of the entire financial planning set. So health insurance here means health insurance for parents and health insurance for the special child. In case of parents who are employed, there would be certain employer provided health insurance cover as well. But apart from that, it is always better to have a personal health insurance. The reason being that if the parents are, if you're changing jobs, what if the next employer does not provide the similar kind of facility? There might be changes in terms and conditions which might not, provide for the kind of cover that you're looking for. So in addition to the employer's health cover, it is always better to have a personal health insurance as well. There are policies for special children, both from the public insurers as well as the private insurers. Generally, in case where it is a normal policy for general public, in that a special child can be covered, but there is a co-pay clause. So you have to pay some 20-30% of the expense if any hospitalization happens, and the rest will be covered by the insurer. So those kind of facilities are available. The public sector insurers have special policies which cover the special needs child. But the limitation there is that the cover provided is about 4 to 5 lakhs, which might not be sufficient in today's times, because going forward also, if you're talking about a child, if you bring inflation into picture, that 4 5 lakhs is insufficient in today's date, and going forward it will become even more nominal. The amount will not be enough. So you have to create a combination of health cover for the special child through normal policies as well as the special child policies provided by the public sector insurance. Apart from this, I would suggest that it is better if you can create a healthcare funding corpus separately, because sometimes there are things which are not covered by insurance policies and the treatment has to be taken. So you will not leave the child untreated for those conditions. That time your healthcare funding corpus will come into play. So it's, if you have the means to make it, please create a healthcare separately. Next comes in the safety net, life insurance. So life insurance cover for the parents. So life insurance cover is not for the child, it will be for the parents, because they are the ones who provide the money for bringing up the child and for all other family requirements. The total requirement for life insurance should ideally cover any loans or liabilities that the parents would have. It should be sufficient to create a lifetime income for the spouse and for the special child to manage a comfortable life. It should cover cost of education for all children. If there are, apart from child, if there are other children, it should cover the cost for all these children. It should also cover all the income needs of the special child, which could include a lot of things like physical equipment or environment to be provided for care of the special child. If there are any caregivers who are engaged, then the payment given to them, any legal expenses, any medical expenses, support professionals who will be engaged to take care of the special needs child. So the fee for all those professionals, all that needs to be covered. So your life insurance should be of a very decent amount. Ideally, both parents would need life cover, because both parents are caregivers. So even if one parent is employed and the other parent is a homemaker, both parents are involved in taking care of the special child. So ideally, both the parents should have life cover. While there are several insurance policies which play on the possibility that you will get a lump sum at the end of certain age, those policies ideally should be ignored. You should be looking at term insurance, which is basically only on death. There is no payout in case you survive the policy term. Now, term insurance policies are also available till the age of 100. So that would be a good option in case of parents of special needs child. The third insurance cover that you should look at is the personal accident insurance. So personal accident insurance covers three aspects. It covers disability due to accident. It covers income support in case of break of income due to accident, and it covers any temporary disability as well. So in case of accident, if there is any disability, say there is a loss of limb or there is a loss of eyesight, and that is a permanent disability, so the accident policy will pay out a specified amount. Say if the insurance cover is 100 rupees and limb loss of limb is defined as 25%, so 25% of the total coverage will be paid out in case of such a eventuality. If there is a temporary disablement, then income support comes into play. So suppose there is an accident and the individual is not able to go to work, and because of there is loss of pay. So to cover that loss of pay, normally most policies provide 2 years, that is 104 weeks of coverage of income. So that is the second important clause. Third is obviously the death in case of accident. So that is a death claim which will arise in case of a accident that happens. So these three aspects are covered by personal accident insurance. These again become necessary for any parent who is having a special child. Now let us come to the next aspect, which is money management. So money management, the key parameters for a family with special child will begin with identifying the money required. So in normal cases, what happens is when we do financial planning, typically the goals are providing for education for the child, their marriage and the parents' own retirement, buying a house, going on vacation, purchasing a vehicle. So while all these other aspects are going to remain, in case of a family with special child, there is an added requirement to provide for the special child for the entire life. So that becomes a critical goal. So that will begin with identifying money required for the special child. You also have to enumerate goals for other children in the family. How are you going to provide for their education? The typical other family goals, buying a house, vehicle, vacations, all those are also going to be there. And then once you define these goals, you come to investment planning and then you plan for the retirement. So let's look at each of these aspects one by one. So identifying money required for a special child, you should ideally create a separate budget for the special needs member. So that will include all probable expenses like support equipment, modification to the existing home, transportation, medical, inclusive schooling, hiring of support staff, or in certain cases even moving from one city to another. So if you have to relocate because of the special needs, maybe they are being met better in a bigger city. If you decide to move, then all those costs will add up. So when you're creating this kind of budget for the first time, it's very difficult to put real numbers onto all these needs because some of these needs would have already arisen. So you know what kind of money goes out in those. But some of these needs you can only estimate. So when you are starting creating a budget for the first time, take some assumptions and go with it. And as you go along, make tweaks and figure out what is a close real expense on all these things. You will get to know as you go along on what kind of expenses are coming up. And you have to be ready to accommodate changes in the budget because these expenses will keep on changing as the child grows, and some of them it is very difficult to visualize in advance. So you will have to keep monitoring and making changing these uh, expenses that are there. Once you have identified what is the kind of expense that is required, you have to estimate what will it cost for a lifetime of covering of all these expenses. Now the challenge here is that, as I mentioned, with age, the expenses, the kind of expenses keep on changing, and it is very difficult to figure out what is it going to be there. And there is obviously inflation, which is not going to go anywhere. I mean, inflation is always going to be there, whether you're working, not working, or whatever situation. So you have to kind of look at inflation also. And while all these challenges are there, you still have to arrive at a realistic figure of what you need to save and invest for your special child so that he or she is not left without critical money support at any point in time. So there are two basic methods of calculating money required for the special child. One is the perpetual annuity method, and second is the inflation adjusted corpus. Now let us look at how both these methods are used and what are the pros and cons of each. So we begin with the expense calculation. So as I said, you first list down what are the expenses. So in this example, we have taken living expenses at 5,000, daily care assistance 10,000. So likewise, the total monthly expense on the child is 40,000. That means the total annual expense is 4,80,000. Now, when we look at the perpetual annuity method, what we are assuming is that if you put this one lump sum amount of money and you're withdrawing the amount required every year, then what will be the corpus required? So to generate 4,80,000 from an investment asset that is earning 3% or 5% or 8%, what are the kind of corpuses that are required? It's a simple interest thing. So if you have 1 crore 60 lakh and you put it in a place which is paying you 3%, you will be able to draw 4 lakh 80,000 per year, right? So likewise, depending on the rate of interest, the amount payable will be 4 lakh 80,000 per year, and this will be the corpus that is required. Now, the problem here with this method is that it is not taking inflation into consideration. It's very simple to understand, but there is no concept of taking inflation. So it is very easy, but it is also necessary to understand that this is the minimum corpus you will require. So this is the base that you can start with. And because the needs keep on changing from year to year, you might need to review this amount every 3 to 4 years. Especially if the child is very young currently, the changes in the expense will be very drastic over the child's growth phase. Now, perpetual annuity method, if you are calculating, it will help you to avoid a huge shortfall. Now, let us look at the second method, which is the inflation adjusted method. Now, suppose the child's current age is 15 years and the life expectancy assumed is 75 years. That is, the child will live up to the age of 75. Current expense is at 4 lakh 80,000. Inflation assumed is 7% and assumed growth rate is 8%. So we are keeping it a little conservative. So basis this, the corpus required will be 2 crore and 21 lakhs. So close to 2 crore 22 lakhs. So if you have 2 crore 22 lakhs and you invest it in a product or a solution that gives you 8% return, you will be able to draw 4 lakh 80,000 per year, increasing at a rate of 7% because we are considering inflation from the child's age of 15 years to 75 years. So this is the kind of corpus that you need. So in this method, what is happening is that you are actually taking inflation. So that's why you will not be surprised when the costs go up. However, there are challenges with this method as well. Life expectancy, again, we have taken an assumption. It could be higher or lower. It is very difficult to estimate accurate expenses in the early years of the child's life. So as I said, the younger the child, the more drastic the changes will be in the expenses going forward. And inflation for special needs child is generally higher than your common inflation that you take at 6 or 7% currently. And we also don't know what kind of returns will be available over so many years. We are talking of 15 to 75 in this example. So that's a very, very long period. So we don't know how the returns will come in those periods, right? So these are the challenges. However, you cannot leave everything to chance. So a good idea would be to maybe use a perpetual annuity method to create a base that is the bare minimum that you will need, and look at figures which are inflation adjusted and arrive at a more realistic figure, because you might not have that kind of money upfront, but you can aim to build that kind of corpus going forward. So it is a method which can be nuanced, and you can build on it with the help of a professional. Now we come to investment planning, because we have already looked at the expense structure. We have looked at how to arrive at what kind of corpus will be required. Now, how do you actually invest the money that you have to ensure that the funds are available as and when required? So you can decide on time-based money goals. For example, you can divide up your goals, the requirements of the money, into immediate or short-term needs, medium-term needs, and long-term needs. So this is a broad bifurcation of the time-based money goals. Now, how do you look at the investments that you will use for each of the goals that you have? So first of all, we have already provided for insurance, assuming health insurance, life insurance, and personal accident is in place. The next contingency planning comes in the form of emergency fund. So in an emergency fund, you need to place at least 6 to 12 months of expenses that are required, and any lump sum other things which will be required for the special child can also be placed in the emergency fund. Now, emergency fund money has to be necessarily invested in liquid products and which are non-volatile. So liquid products means as and when you need the money, you will be able to withdraw it without any penalties or without any lock-in period that is there. And the product should be, the return should be very non-volatile, because if you look at a product like equity, it is a very volatile return product. So sometimes the markets, when they are up, your returns will be good. sometimes the returns also might be negative. So you cannot place your emergency fund money in any volatile kind of product. The immediate or regular expenses should be again in liquid investments. It could be, a combination of maybe a savings bank account, bank fixed deposit, or maybe some debt mutual funds, liquid mutual funds. Those kind of products can be used for immediate or regular expenses. It can also obviously be provided from your income stream. So depending on what kind of plan you're building, it can be derived from different sources. The short-term requirements can be put into conservative investments. Medium term can be put in more moderate growth investments, which could be hybrid products which have some equity and some debt. And the long-term goals, I mean the 7-year and beyond kind of expenses have to be put into growth investments, because you also need to look at inflation beating kind of returns. Otherwise, you will fall short of money when you really need those for bigger goals. Now, while I gave you a broad idea of, for each time period, what kind of products are to be used, let us look at what kind of asset classes and what are the issues and pros and cons of each asset class. So the broad asset classes that you can invest in are debt, equity, real estate, and commodities. For practical investment purposes, in commodities, we are only looking at gold and silver because they're the most easy to understand and also easy to invest. There are other commodities also, but they are not suitable for this discussion at this point in time. So when you're selecting any investment product, how do you judge whether that product is suitable for you or no? So there are three critical aspects. First is safety, second is liquidity, and third is growth. So typically what happens is most people look at what kind of returns the product is giving and ignore the other two aspects. So ideally, you should arrive at a combination of safety, liquidity, and growth to judge what is a good product. So what do you mean by safety? So safety means the safety of your principal and safety of your regular payout. So whatever form they might be in, whether they will be in form of dividends or rentals or any other form that you may have. So is your principal going to be safe? So how do you judge that? So the primary way of judging the safety is whether, first of all, the product is regulated. So you see if the product is regulated. Any unregulated products will likely be unsafe. I mean, they will be taking kind of risks which are probably not suitable to your requirement. And also, if something goes wrong, you don't have any fallback option. You don't have any regulator whom you can complain to and try to get your money back. So in case of safety, you should ideally look at the four regulators that are there in India. SEBI is for all security market instruments. Reserve Bank is for all banking and currency related. PFRDA is for the pension funds, and IRDA is for all insurance related products. So these are the four regulators. So whenever you offer the product, first ask what regulator is covering this product. And if there is no answer, that is the first red flag. Now, if we look at liquidity, you have an idea based on the time period that we discussed in the earlier slide when the money will be required. So basis that you can decide, whether that product will provide liquidity or no at that given point in time. For example, let's take PPF. So PPF is a 15-year product. So you cannot link that kind of investment to a goal that is arriving in the next 4 to 5 years, because you will not be able to withdraw the money. Whereas if you have a goal which is say 20 years down the line, if you're talking about retirement, you would ideally not look at simple debt products. So you would rather look at equity products which are liquid also, but which have a long duration thing. The third thing that you need to look at is what kind of growth will that product provide. So growth is essentially for the kind of returns that you are getting. So products which are short term in nature, short term, say fixed deposits or treasury bills or debt instruments like maybe a national savings certificate and all those kind of things, those will have a lower rate of return. So they will provide you safety. They might not provide you liquidity in certain products, but they will also not provide you great amount of growth. So you have to come at a combination. Growth products are typically real estate and equity. So these are all long-term products. wherein you need to understand that you might be putting your money at risk if you're looking at a short-term withdrawal. So there is a risk involved there. So arrive at a product which is amongst the four asset classes that we discussed earlier, the debt, equity, real estate, and commodities, and then look at this parameter of safety, liquidity, and growth and decide on the product. Now, when you're creating an investment portfolio, your important thing to understand is diversification is the key. So you have to have different kinds of products in the portfolio because the risk returns parameters are different for different products, and not every product will play at every point in time. So if you have a diverse portfolio, it is likely that you will get a better risk adjusted return. If you're being too conservative, you will have a higher burden of accumulation, because obviously if the returns are less, I mean, you're putting it in a conservative product, the returns are less, the inflation beating factor will not come into play. So if you have a product which is giving you 6% return, whereas the inflation is at 7%, you will never be able to reach your target. Also, if the return is 8% and your inflation is 7%, you will have to put more money to reach your target. So being too conservative will increase your burden. So take a little risk and put some money into assets which are riskier but which will pay off in the longer term. Equities are necessarily long-term investment, so don't get pulled in by ideas that suggest equities for short term. That's not a good idea at all. Avoid falling in trap of quick gains with stock tips. You might lose your principal in the greed of getting quick gains with stock tips. Debt also is not a risk-free option. So in debt, there are different kinds of risks. So there could be credit risk. So if you're putting money in, say, for example, company fixed deposits, and the company is not great, I mean, the rating is not good. If the company is not good, you might not get your principal back. Obviously, there is also a risk to the regular payout. So even though it is a debt product, it might not be risk free. So there are different kinds of risks that are there in debt. You have to evaluate and choose the risk that you're willing to take. Inflation and taxation will obviously cut down the actual amount that you have in hand when you need the money. So when you're doing your calculations, do build in inflation and look at taxes. So look at building a tax efficient portfolio. Most often people confuse taxes with putting money into tax saving products. The idea is not to put money into tax saving products. The idea is to build a portfolio in such a way that you are more efficient in paying your taxes. You either defer your taxes or you reduce your taxes in the way your portfolio is built. So in building the portfolio, that becomes an important aspect. One thing to understand for a family with special child is that Section 64 clubbing does not apply to a disabled child. Disability as defined under Section 80U. Now, what this means is, in a normal cases, what happens is if a parent is investing some money in the name of his or her child, the income earned on that investment is clubbed with the parent's income, and the parent has to pay tax on that. In case of a special child, if the disability is as defined in Section 80U of the Income Tax Act, this clubbing rule will not apply. So if the money is invested in the child's name, the clubbing rule does not apply. So the parent does not have to pay tax on that particular investment. So that is a benefit that has been given to a family with a special child. Now we come to retirement planning. So retirement planning in a normal case is only planning for the expenses of the parents. So expenses could be daily living expenses, it could be healthcare funding, it could be gifting, traveling. But in case of a special child, there is a second retirement plan which needs to be made, which is basically providing for the special child as well, as long as he or she lives. So retirement planning is in itself a very critical goal for all families. With a special child, it becomes doubly important because the parents are deteriorating in their health, they are aging, they have their expenses going up in terms of healthcare and other things, and there is a special child who also needs to be taken care of. So the amounts required in retirement planning with families with special child will be much, much higher than what is there for other families. So let us look at some documentation that will be required in case of families with special children. So first, as I discussed earlier, is the legal guardianship. So if the child is becoming an adult, there will be a legal guardianship requirement. I mean, you need to get the legal guardianship certificate from the court after the child turns 18. The second thing is making a living will. This is a new concept in India. It has recently been recognized, and the paperwork for the living will has also been resolved only as early as last year, and there are still changes happening. So, what is essentially living will does is that in case of a situation where the person is not able to decide whether to take further medical aid for living or no, in that case, the person creates basically a guide that okay, in these situations, please do not give me life support, please do not put me on ventilator or do not give me dialysis. So the decisions that need to be made by a family when the person is hospitalized, it makes it easy if there is a living will in place. So you know the requirement, I mean, what the person who's hospitalized is wanted to do. I mean, did he want to extend his life by all these kind of supports or no? So that decision becomes easier. So there is a written document called living will, which you can do while you are well, and that will come into play in case there is a hospitalization required. Will of both parents is needed because in case of a special child, it is necessary that if the child is a minor, there has to be a guardian who's, told in the will that this person will be the guardian in case both the parents are not alive. There is also a decision. Will by itself becomes important in normal cases also because how will you bequeath your property? How will you bequeath your assets? In case of a special child, it becomes more complex because you have to provide for living expenses of the child much beyond your own age. So how will you provide for that? So will can be one of the ways in which you write it down that okay, this amount of money will go to this child and the other amount will go to other child, and all those kind of things can be written down in the will. Also in a will you can create a trust through a will, so that is called a testamentary trust. So after the parents, some money from the parents can go directly into a trust which will take care of the special child. So that is also one of the positive points of writing a will. Most cases, in case of a special child, private trusts are created. So if private trusts are created, it becomes easier to take care of the financial requirements of the child. You can put down names of trustees, you can put down names of guardians, and you can put down how specifically the investments will be made, how the monies will be paid out. All that can be defined in the trust. And it is easier to maintain that trust for the special child beyond the lives of the parents. So these are some documents which are important for parents of special children. Now we come to estate planning. So estate planning is basically how will you bequeath your assets. Now in case of special children, as discussed earlier, it is also for providing for the special child who will take care after us. So distribution of assets to either a sibling or a family member who can take care of the special child. That is one way in which you can do it. So see, each of these things has pros and cons. There is also a lot of trust which needs to be reposed in the people that you are, distributing the assets to, that they will take care of the child and, live as per the intent of the parent for the child. Now, the gifts also can be bequeathed to a guardian who will be maintaining for the special needs child, whoever will be taking care of the special needs child. You can also look at establishing a trust in your lifetime or through a will. As I said, the testamentary trust can be created. So these are some ways in which you can plan for providing for your special child after you. So these are important aspects. Now, this is a very, very vast subject. It is very difficult to cover it in 40-45 minutes, but I just gave you a brief glance of what needs to be done. So while working for, securing the future of your special child, it is good if you can deal with a professional who can explain all these things to you and take care of the paperwork, and help you in setting up things the way you want to. It is a very vast subject and I have tried to cover it. So I think some of these things can also be covered in the Q&A if any one of you has questions on this. So this is a disclaimer. You can take a minute to go through this. Thank you very much. So we'll have the Q&A now. So, okay, I have some questions which I can see here. Okay, can you please explain the copay and any other insurance besides term? Okay, so copay is basically when you have an insurance policy, say of uh, for simple example, take a policy of 100 rupees. Now, if there is a copay of 20%, so when there is a expense that comes up, out of that 100 rupees, 20 rupees will be paid by the person who has taken the policy, and the 80 rupees will be covered by the insurance company. So that is called copay. Besides term insurance, there are other insurance policies that pay out. So there could be endowment policies which pay out at say 20-25 years. There could be ULIPs, which are unit linked insurance plans. There could be whole life policies. So basically all these other policies are investment cum insurance policies. So they not only provide a cover which pays out in case of death during the term of the policy, but they pay out in case you survive. So it's a 20-year policy, you get some money at the end of it. The problem with these policies is that because there is an investment component, the premium becomes very heavy and the coverage is small as compared to the premium. So whenever you pay a premium, there are two basic components. I mean, there are other, but the main components are your insurance premium and your investment component. So in case of a term plan, since there is no investment component, the premium is very small. And for a small premium, you can have a very large cover. Say for a 1 crore premium, 1 crore cover, the premium for say a 25-year-old could be as low as 5,000 rupees. So in that scenario, you can have a larger cover with a smaller premium. So in case there is death during the term of the policy, your family gets that lump sum amount of 1 crore rupees. So that is the simplest form of insurance. Okay, section 64. Section 64 is basically the clubbing section. I mean, you can go to the income tax website and read about it. What it essentially says is, in case of children, I will explain that if you are gifting as a parent, if you're gifting any money to your child, and that money gifted to the child is invested, say, in a fixed deposit. Now, the fixed deposit is going to pay some interest. That interest will be clubbed with the income of the parent. So the parent will have to pay tax on that income out of that fixed deposit. But if the child is a special child and the disability is what has been defined under section 80U, then that income will not be clubbed with the parent. Then that income will be the child's income and the taxation will fall upon the child, not upon the parent. Okay, there are issues while giving term insurance for housewives, as term insurance requires earning. By default, they get only 25% of husband's coverage. This is a comment given by Mr. Anand Kumar. Yes, Anand, there is definitely issue. I mean, if the housewife is not working, but there is also a clause which says based on education, the housewives can get a higher cover. So that is available. So case to case basis, you will have to check what the insurance company is providing. Generally, life insurance coverage is declined for special need child. Is there any other provisioning? Asking Shelly Ahuja. Shelly, see, life insurance coverage is not required for the child. If you understand the concept of life insurance, it is for the parent who's earning or parent who's providing support. So you don't really need a life insurance policy for a child. You need to cover the parents. So if the parents die, the amount of coverage, the money will come to the nominee. That could be the special child or the spouse, and that can be provided for the expenses required. So you don't really need life insurance for child, whether it's a special child or a regular child. Vasudev Nagar says, what if the will of living clashes with the family will? So I didn't really get that question. Manisha is asking, what are the 4 safety schemes like SEBI? So Manisha, what I mentioned was the 4 regulators. The 4 regulators are SEBI, Reserve Bank of India, IRDA, which is for insurance, and PFRDA, which is for pension schemes. So these are the four regulators in the country. The child can have health insurance. Yes, the child can have health insurance. It is uh, better to have the child covered in the health insurance because those requirements will come up. And as I said, there are policies from the public sector insurers that are up to 4-5 lakhs, which are specially for special needs children. In the other private sector policies also, as I said, with copay, you can get a health insurance for your special child. Trust document. Okay, so trust by itself is a very large, discussion. It is not possible for me to cover it in detail. So when you create a trust, you are essentially creating a separate entity which will take care of your child's requirements. So you put money into the trust, and that trust will pay as per whatever you have decided. So you can decide how a trust is formed, what will be the payouts, who will be the trustees. So your trust can actually go beyond your life. That is the reason a trust structure is suggested, especially in case of special need children. Uh, Sudhir Kumar, yes, we need a guardianship certificate even if natural guardian is alive, because if a child is above 18, it is considered as adult. So even when normal children are above 18, they are considered adult and they have signing authority. They can, do acts on their own, which are opening bank accounts and other things. Whereas in case of special needs child, you are, though you are a natural guardian, you will need to take a legal guardianship certificate because you have to act on behalf of the child, as the child cannot make a decision on his or her own. Ajanta, you are asking about term insurance in special child name. That is not required, as I clarified. You need to take term insurance for the parents, not for the child. I think there are a lot of questions on trust, but it is very difficult to explain trust in a very short time. I hope there will be some other sessions where a trust will be explained separately. It is not possible to cover it in this period of time. So thank you all, and hope you find some benefit in today's session. Thank you so much.
Thank you so much, ma'am, for taking the time to speak at our webinar. Your insights, expertise, and engaging presentation made a lasting impact on our audience. Thank you once again for sharing your time and knowledge with us. Wishing you a wonderful day ahead. Thank you, ma'am.